You walked in, you waited, a provider spent maybe 20 minutes with you, you walked out. From your perspective, the visit is over. From the practice's perspective, the visit just started. I'm Heather Skousen, and this is Behind the Business of Healthcare. Today, we're going inside the room you never see, the billing office, the coding queue, the claims clearinghouse, to understand why a routine appointment can generate months of phone calls, letters, and perplexing charges. This episode is for patients who have ever started an EOB and thought, what is this even saying? It's for practice managers trying to keep the lights on while chasing down denials. And it's for healthcare leaders who know revenue cycle management is both a science and a full contact sport. I'll be honest with you, I debated about breaking this into a two-part episode. There's frankly a lot here, and I could have drawn a clean line somewhere in the middle and called it a cliffhanger. But I decided to keep it together because this process doesn't really work as two separate stories. Each step builds on the one before it. The reason your bill looks the way it does traces back to the decisions made in the coding queue. The reason a claim gets denied traces back to documentation written in the exam room. Pull it apart and you lose the thread. So, we're doing this in one setting. Get a coffee or a snack if you need one, and by the end, the whole picture will make sense. Let's start at the very beginning, not the appointment, but before the appointment. Here's the first thing most patients don't realize. Your insurance has already been partially verified before you ever check in, or it should have been. This is called eligibility verification, and it's the first link in a very long chain. A front desk coordinator, an insurance specialist, or an automated system checks with your insurance carrier. Is this person covered? What's their deductible? Have they met it? Do they need a referral? Is this provider in network? For patients, this matters because you bear the consequences when it's skipped or done wrong. If the practice doesn't catch that you switched insurance plans last month, you might get a bill 6 weeks later for the full cost of the visit. For practice managers, eligibility errors are one of the most preventable sources of claim denial and one of the most common. Industry data consistently shows that eligibility issues account for anywhere from 20 to 30% of initial claim denials. That's money sitting on the floor. For healthcare leaders, this is the moment where technology investment has the clearest return on investment. Automated eligibility tools, real-time verification at booking, not just a check-in, can dramatically reduce downstream write-offs. The question isn't whether you can afford to invest here, it's whether you can afford not to. So the patient arrives, they check in, they see the provider. What happens the moment the door closes and they leave? Every diagnosis, every procedure, every prescription, it has to be written down and written down correctly because everything that follows, every dollar the practice gets paid, flows from the clinical documentation. The provider finishes the visit and either dictates notes, types them directly into the electronic health record, or in some cases uses AI-assisted documentation tools to capture the encounter. Those notes then go through a process called charge capture, translating what happened clinically into billable services. Think of it like this. The provider speaks the language of medicine. The insurance company speaks the language of codes. Charge capture is that translation. Almost every single service in healthcare has a code. Your diagnosis, there's an ICD-10 code for that. The procedure, there's a CPT code. The level of complexity of your visit, that's an E&M code, evaluation and management. Whether it was in the hospital, an office, or via telehealth, that affects the place of service code. We're going to talk a lot more about those codes in a moment. But first, that documentation, it needs to be complete, specific, and timely. I would often tell my providers, if it's not documented, it didn't happen. Because you can't code what isn't documented, and you can't bill what you can't code. Medical coders are, in my opinion, one of the most underappreciated roles in all of healthcare. They are professional translators sitting at the intersection of clinical medicine, insurance policy, and federal regulation. Their job is to read the clinical documentation and assign the correct codes with exceptional precision, because the difference between one code and another could mean a denied claim, a compliance violation, or thousands of dollars. Let's make this concrete. Say you came in for a knee injury. Your provider documents patient presents with right knee pain following a fall. X-ray shows no fracture. Diagnosis: acute sprain of the medial collateral ligament. The coder now has to assign an ICD-10 diagnosis code for the sprain, and it matters whether it's the right or the left knee, whether it's an initial encounter or a follow-up, and the specific ligament involved. ICD-10s have over 70,000 codes. This is not an exaggeration. A CPT code for the office visit at the correct level of complexity based on the time spent and medical decision making involved. Potential separate CPT codes if an X-ray was taken and read in the office. A modifier if needed to indicate that two procedures were performed together or that the physician had an assistant. Get any of that wrong and the claim may be denied, underpaid, or if it's a pattern, flagged for an audit. For patients, this is why your bill sometimes looks nothing like what you expected. A regular checkup might actually contain 4 or 5 separately coded services. It's not a trick, it's the system working exactly as designed, for better or for worse. For practice managers, coder quality directly impacts your bottom line and your compliance stance. Undercoding, which is assigning a lower level code than is actually supported, is money left behind. Upcoding is fraud. The difference between the two is documentation, and accurate documentation is a team sport between providers and coders. For healthcare leaders, the shift to value-based care and risk-based contracting makes accurate diagnosis coding more important than ever. HCCs, used in Medicare Advantage and risk adjustment models, mean that missing a diagnosis code doesn't just affect this claim. It affects your patient's risk score, your capitation rate, and your quality metrics for years. Coding is infrastructure. Treat it like it. I know we've already covered a lot of ground, and we're not even halfway through. Are you still with me? Good, because what's coming next is where it really starts to make sense. Everything we just talked about, the documentation, the coding, and the claim, it all leads to this next part. And this is where most people finally understand why the bill looks the way it does. Stay with me. Once the documentation is coded, it becomes a claim, a formal request for payment submitted to the insurance carrier. Most claims today travel electronically, formatted according to something called an 837 transaction, through a middleman called a clearinghouse. Think of a clearinghouse as a post office for healthcare claims. It receives your claim, checks it for basic formatting errors, and routes it to the correct payer. The clearinghouse checks things like, does the provider MPI number match? Is the date of service in the right format? Are the required fields populated? These are called front-end edits, and they catch technical errors before the payer ever sees the claim. This is honestly good for everyone. It's faster and cheaper than waiting for a payer to reject something weeks later. If the claim clears these checks, it goes to the insurance company. And now the real wait begins. For patients, the date the claim is submitted is almost never the date your provider got paid, or the date you'll know what you owe. The insurance company has their own processing timeline, often 30 days, sometimes up to 45, and longer for complex cases. This is why you get an explanation of benefit in the mail weeks after a visit. For practice managers, clean claim rate is one of your most important KPIs. A clean claim is one that goes through on the first submission without error or additional information. Industry benchmarks put the target at 95% or higher. If you're below 90%, your denial rate is probably costing you more than you think, because every rework is labor and every delayed payment is cash flow. One more thing worth emphasizing here. The clearinghouse is entirely electronic, which means claim rejections and claims that never reach the clearinghouse at all can slip through without anyone noticing. Most RCM software has dashboards designed to catch these issues, and they're valuable, but a dashboard can only surface what it's configured to see. Here's a real-life example of why that matters. We had our billing outsourced to a revenue cycle management company, and I noticed that days in AR for a specific payer were sitting outside the normal range. When I flagged it, the initial response from the billing company was that nothing was appearing on their dashboards and their reports looked clean. No problem detected. I pushed for a deeper look anyway. What we found was that the clearinghouse had failed to deliver several weeks' worth of claims to that payer. When we contacted the insurance company directly, they acknowledged they'd been experiencing a receiving issue and told us that if we needed payment, we'd need to submit those claims manually until it was resolved. The dashboards weren't wrong, they just couldn't see what wasn't there. Good practice managers and healthcare leaders recognize when something feels off. Great ones don't stop until they find out why. The insurance company receives a claim and runs it through a process called adjudication. This is their internal review. Is this covered? Is this the right provider? Was a prior authorization obtained? Does this service match the diagnosis code submitted? There are several possible outcomes. Paid. The carrier pays its portion, sends a remittance advice to the practice, and sends an explanation of benefits to the patient. In a world where everyone does everything right, this is what happens. Denied. The claim was rejected for a specific reason. Common reasons include the service wasn't covered under the patient's plan, a prior authorization was missing, the diagnosis didn't support the procedure medically, or a coding error. Every denial has a code, and that code tells the practice what to do next. Suspended or pending. The carrier needs more information before they can make a determination. This is medical review purgatory. It's where claims go when the payer wants clinical notes, records, or additional documentation. One of the most confusing models for patients and many physicians who own practices to grasp is adjustments. The carrier paid, but not at the billed amount. This is where two concept patients and practice teams need to understand come into sharp focus: the charge master and contractual adjustments. Let's talk about the charge master first, because it's one of the most misunderstood things in all of healthcare finance. Every hospital and most practices maintain what's called a charge master, a master list of every service they provide and the full price they charge for it. That knee x-ray, it might be listed at $400 on the charge master. That office visit may be listed at $350. Here's the thing. Almost nobody pays charge master rates. Not insured patients, not Medicare, not Medicaid. The charge master is essentially the sticker price on a car lot. It's the opening position in a negotiation that already happened years ago when your insurance carrier and the provider signed a contract. That contract specifies the actual reimbursement rate, what the insurer will actually pay for each service. It might be 40 cents on the dollar for some procedures and 70 cents for others. The difference between the charge master rate and the contracted rate is written off as a contractual adjustment. It's not money lost. It was never realistically expected. It's an accounting entry that makes the books balance. For patients, when you see a line on your EOB that says amount billed versus plan discount or contractual adjustment, that discount is the difference between the charge master price and what your insurer's contract actually allows. You don't owe the billed amount. You never did. For practice managers, charge master integrity matters even when most of those rates never translate to actual revenue. Rates set too low can limit your leverage in payer contract negotiations. Rates set irrationally high can create compliance exposure. Review your charge master annually alongside your payer contracts. Regarding denials, there are many reasons why an insurance will deny a claim. I will dedicate an entire episode on denials and how they impact practice, cash flow, and what can be done to lower your denial rate. For healthcare leaders, reimbursement rate optimization, the gap between what you're contracted at and what the market will bear, is one of the highest value strategic conversations in healthcare finance. Most organizations leave money on the table in renegotiations simply because they don't have benchmarking data to anchor the conversation. Now, a word about something that trips up patients constantly. Being covered does not mean a claim will be paid. I want to say that again because it matters. Your insurance card says you're covered. Your provider is in network. You showed up, got care, and left, and 6 weeks later, the claim is denied. How? Because covered describes your plan's general benefits. Paid requires that a specific claim for a specific service on a specific date submitted with the correct codes and documentation and clears every single requirement the payer has in place. Coverage is the door. Adjudication is the key. You need both. Common reasons a covered service still gets denied: wrong place of service, missing prior authorization, incorrect coding, a diagnosis that doesn't support the procedure in the payer system, or a plan exclusion buried in the fine print that nobody knew about. Covered and approved are not synonyms. For patients, if a claim is denied for a service you believe is covered, appeal it. The denial letter must include the reason and the appeals process. Many denials get overturned on appeal, especially when additional documentation is submitted. Don't accept the denial as the final word. For practice managers and leaders, front-end eligibility verification should include benefit verification, not just coverage confirmation. Knowing a patient is covered is table stakes. Knowing whether their specific procedure requires prior authorization, whether the diagnosis codes will be supported, and what their cost sharing will be, that's the work that prevents denials before they happen. There's a related point here that catches everyone off guard at least once, and it has to do with prior authorization. When a provider's office calls an insurance company to ask whether a procedure requires prior authorization, and the answer comes back, no authorization required, that is not an approval. It is not a guarantee of payment. What it actually means is that the insurance company reserves the right to review the claim after the procedure is already done and make their coverage determination then. Think about what that means in practice. The provider completes the service, the patient receives the care, and only afterward does the insurance company decide whether they're going to pay for it. Healthcare may be the only industry where a professional can complete a significant amount of work with no reliable assurance they'll be compensated for it. There is a tool that offers more protection, called a predetermination. Before the procedure, a provider can submit the diagnosis and the CPT codes they plan to use and formally ask the insurer to indicate whether they would cover it. A favorable predetermination puts you in a much stronger position if a claim is later disputed. The catch is that many insurance companies don't offer predetermination readily, and those that do may not make the process straightforward. We'll go much deeper on the difference between prior authorization and predetermination in the next episode. It deserves its own conversation. When a claim gets flagged for clinical review, meaning the insurance company wants to take a closer look before paying, it usually falls into one of two different categories. And understanding the difference matters enormously for how you respond. The first is a medical necessity review. Medical necessity is the clinical question: was this service appropriate for this patient given their diagnosis and condition? The payer is asking, did this patient actually need this procedure based on the clinical evidence in the chart? Medicare defines medical necessity as services reasonable and necessary for the diagnosis or treatment of illness or injury. Commercial payers have their own definitions, but the concept is the same. A medical necessity denial says, we're not disputing that this service exists in our benefits, we're questioning whether this patient needed it. Medical necessity reviews are fought with clinical documentation. If the chart is thorough, if it tells a coherent story about why this patient needed this service on this day, you have a strong basis for appeal. Physicians write letters, records get submitted, and often the denial gets overturned. The second type is a medical policy review. This is a different animal entirely. Medical policy is not a clinical question, it's a coverage question. Every insurance carrier maintains clinical policies, written documents that define, for each type of service, exactly what criteria must be met for the payer to consider it a covered benefit. These policies are often more restrictive than what the clinical evidence actually supports, and they vary significantly from payer to payer. A medical policy denial says, regardless of whether this patient clinically needed the service, it doesn't meet our policy criteria. Maybe the policy requires a certain diagnosis code to be present. Maybe it requires that a less invasive treatment be tried first. Maybe it limits coverage to a specific patient population that your patient doesn't technically fall into, even if every clinician in the room agrees the care was appropriate. Medical policy denials are harder to overturn because they're not really about the individual patient. They're about whether the carrier's written policy permits the claim. Appeals require a different strategy. You're arguing that the policy itself shouldn't apply, or that the patient does meet the criteria on a closer reading, or in some cases, escalating it to an external review. For patients, if a claim is denied for medical necessity, ask your provider to write a letter of medical necessity and appeal with your clinical records. If the denial is based on medical policy, ask specifically which policy applies and request a copy. You can look up many payers' clinical policies on their websites. They're often publicly posted. You have the right to know exactly why coverage was refused. For practice managers, your denial management team should be categorizing denials by type. Medical necessity denials require clinical team involvement. Someone needs to pull the chart and build the appeal. Medical policy denials require a policy review. Someone needs to read the actual policy document and determine whether the claim meets criteria on a careful reading, or whether there's grounds for a peer to peer review between the treating physician and the payer's medical director. For healthcare leaders, payer medical policies are not static and they're not always evidence based. Carriers update them regularly, sometimes in ways that quietly shift coverage from entire service lines. Monitoring payer policy updates, particularly for your highest volume or your highest cost procedures, should be part of your contracting and revenue integrity strategy. When policy changes threaten coverage for services your patients legitimately need, that's a provider relations conversation, not just a billing problem. Okay, I'll be honest. Those last sections were a lot. And if you're a patient watching this and your eyes glazed over a little bit, I completely understand. Clearinghouses, adjudication, medical necessity versus medical policy, it is all dense territory, even for people who work in this industry every day. But I need you to wake up right now because this next part, this one is personal. This is where we talk about the actual bill, the one that shows up in your mailbox weeks after your visit with a number that makes no sense. We're going to break down exactly what you're being charged, why your cost sharing works the way it does, and how to read that EOB so that you actually know what you owe and why. This part is for you, so don't skip it. Once the insurance carrier has paid their portion, whatever remains becomes the patient responsibility. But before we talk about the bill, we need to talk about what's actually in it, because most patients have never had anyone explain the mechanics of cost sharing in plain language. There are three main buckets. The deductible. This is the amount you pay out of pocket each year before your insurance starts covering most services. If your deductible is $2,000, the first $2,000 of covered medical cost in a given year is entirely on you. The insurer pays nothing towards most services until that threshold is met. Coinsurance. Once you've met your deductible, coinsurance is the percentage you continue to pay for covered services. If your plan has 20% coinsurance, your insurer pays 80% and you pay 20%, up until you hit your out-of-pocket maximum. Coinsurance is a percentage. It scales with the cost of the service. The copay. A flat dollar amount you pay for a specific type of visit. For example, $30 for a primary care visit or $60 for a specialist. Copays are usually collected at the time of service and may or may not count towards your deductible depending on your plan. Here's where it gets confusing. These three cost-sharing mechanisms often apply simultaneously in different combinations for different services, depending on what your specific plan says. A patient might owe a copay and coinsurance on the same visit, or they might owe their full deductible first, then nothing because they hit their out-of-pocket max. And critically, none of this is calculated until after the claim is adjudicated. The insurer processes the claim, applies the contracted rate, determines what they owe, calculates what you owe based on your current deductible status and benefits, and then sends the calculation to the practice, which is why your bill arrives weeks after your visit. This brings us to a question patients ask constantly. Why did my bill change after I already paid? A few things can cause this. The most common, a claim gets reprocessed. Maybe a secondary insurance was identified after the fact. Maybe a prior authorization was retroactively approved or denied. Maybe the original claim had a coding error that was corrected and resubmitted. Maybe A coordination of benefits investigation determined that your insurer should have been the secondary payer, not the primary, and now the math changes entirely. Another common cause, your deductible status. Insurers calculate your patient responsibility based on how much of your deductible you've already met at the time of adjudication. If a different claim processed first and ate some of your deductible, your responsibility on this claim changes. The practice didn't make an error, the math legitimately shifted. And sometimes, let's be honest, it's a billing error. The charge master code was wrong. The insurance was billed incorrectly. A payment was posted to the wrong account. These things happen. Ask for an itemized statement. Check it against your EOB. Speaking of which, let's actually talk about what an EOB is, because a lot of people throw them away without reading them, and that's a mistake. An explanation of benefits is not a bill. Let me say that again. It is not a bill. It's a statement from your insurance company explaining how a claim was processed. It shows the service billed, the amount the provider charged, what the insurer paid, what contractual adjustment was applied, and what you owe. Every line on an EOB maps to something real. If you read your EOB and then compare it to the bill from your provider, they should match. If they don't, if you're being billed for more than an EOB says you owe, that's a red flag worth investigating. The EOB also tells you if a claim was denied and why. It's your scorecard for every claim that's been submitted on your behalf. Most are available digitally through your insurer's member portal now, often before the paper version arrives in the mail. For patients, get in the habit of reading your EOBs. Match them against your provider bills. If the numbers don't line up, call the billing office with the EOB in hand. And if a claim was denied for a reason that doesn't make sense to you, the EOB is the starting point for an appeal. For practice managers, patient confusion about EOBs is one of the leading causes of delayed payment and unnecessary billing disputes. Consider adding a simple one-page explainer to your new patient intake packet. What is an EOB and what to do with it? It's a low-cost intervention that reduces inbound calls and increases on-time payment. For healthcare leaders, the patient financial experience, how clearly people understand what they owe and why, is increasingly a quality metric, not just a collections metric. Organizations that invest in financial literacy tools, transparent cost estimates, and plain language billing see significantly better patient satisfaction scores and lower bad debt rates. So let's come back to the title of this episode. Why does a 20-minute visit take 3 months? Here's the timeline in a best case scenario. The smooth version. Add in a denial that needs to be reworked, a medical necessity review that takes 30 days, a coordination of benefits investigation because the patient has 2 insurance plans, or a prior authorization that was retroactively denied, and you're easily into month 4 or 5. Every step in this chain has its own potential point of failure, and it all began with a conversation in a room that lasted 20 minutes. This is why revenue cycle teams use terms like days in accounts receivable and clean claim rate and denial overturn rate. They're trying to measure and shorten every one of those delays because every day a claim sits unresolved is a day the practice hasn't been paid for work it already did. Healthcare billing is one of those systems that looks simple from the outside. You go in, you get care, someone gets paid, and turns out to be almost incomprehensibly complex when you zoom in. The charge master and the reimbursement rate, the deductible and the coinsurance, the medical necessity denial and the medical policy denial, the EOB that isn't a bill but tells you everything you need to know. These aren't obscure insider concepts. They're the mechanics of a system that affects every single person who seeks medical care. Within the system there are people working every day to navigate it. Coders who memorize thousands of codes. Billing specialists who fight denials with tenacity most people reserve for things they actually enjoy. Front desk staff who have to ask uncomfortable questions about insurance before someone even sees a doctor. Understanding this process doesn't fix it, but it changes how you move through it. Whether you're the patient reading a confusing bill, the practice manager staring down a 25% denial rate, or the healthcare system leader trying to figure out where the revenue went. The appointment ends, the work doesn't. I'm Heather Skousen, and this is Behind the Business of Healthcare. Next episode, we're talking about prior authorization, the process that everyone in healthcare agrees is broken and somehow still exists. And we're not doing it alone. I'll have a special guest who has spent over 18 years in the trenches, which means she's seen the system at its worst, figured out how to work it anyway, and has the battle scars to prove it. Whether you're just starting out in revenue cycle or you've been doing this long enough to have strong opinions about it, and trust me, everyone does, there will be something in this conversation for you. That one's going to be fun. Until then, ask questions, read your EOB, and for the love of everything, verify your eligibility before you walk in the door. If this episode answered some questions you didn't even know how to ask before, subscribe now and give it a like. It helps more people find the channel. We are just getting started, and there is a lot more to uncover.